So I'll start with the brief history of how we got to dark pools, because I feel like most people don't understand trading. So before there was even algorithms, there were pits. And if you were, say, Brevin Howard, and you had a position, you had a broker that handled your order. And your broker you would call, or you let them know ahead of time through a phone that had cords on it. And you would say, okay, sell whatever, 100 million euro dollars at this price. And the broker would be in the pit, and he would ask for bids, and they would do signs, because you can't really hear. So everything was all signs. So you had hand signs, because there's nothing digital back then. And if you were smart as a market maker, you knew that that broker is Brevin Howard's. So what would you do? You would take down that order and then sell with, right? So you would reposition your book to be in the same direction as Brevin Howard, which is essentially kind of front running, to some extent, right? So you're repositioned that way. So that was number one. Number two is now you move ahead and you have algos, right? So you still have your pit traders, and now you have traders upstairs that are seeing live markets, right? So they're still communicating. Now we actually have like headsets and phones. So you have a phone that's still with a cord, but it's connected to another phone on the desk that you can relay messages back and forth, right? So the desk guy, he's seeing a lit market. It doesn't have necessarily all the liquidity as the pit, but he can still trade around it. So now you have this opportunity where the pit guy is saying, okay, Brevin's selling, and the guy upstairs is like, fuck that, sell everything, right? So they're selling upstairs, the pit guy's hitting everything, trying to sell everything too. So now you have two ways. And then people realize algos are way faster. Why do we need a pit? So now everything moves upstairs. And now you can't really see who the broker is, but you decide to train a bot, because you can say, well, if the selling pressure over this time period is in this area, it's probably going to go down. You've created a predictive model, and now you're going to see it, and now you're going to start selling with it. So you start using market microstructure to sell along with and reposition yourself. Problem is, when you're that size, you're like, well, fuck, I can't really change my position without putting something in a lit order book. So my orders are shown in this lit order book. There's not enough volume there. If I put an order in, people are just going to move away from me. So what can I do? I'm going to go to my prime broker, maybe a bank. I'm going to have a sales trader. They're going to call around to the other hedge funds and see if they can take that position. So the price slippage is going to be better than if I put it on the lit order market. So the bank goes, wait a second. Why am I just giving this to my other hedge fund clients? I think a lot of them need this service. I'm just going to cross them internally. So this is how dark pools basically came up, right? They have a counterparty on one side that wants to sell, and they figured out they have a counterparty on this side that want to buy. But instead of having their sales trader call around, because sales traders get really expensive, when they say, hey, I crossed a whole bunch of shit, you owe me millions of dollars every year, when you can have an algo do it, right? So they replace sales traders with an algo that just matches internally, and there's some rules that the SEC says you have to have, it has to match like the best bid, best offer of the lit market, and you can match internally and you can cross internally. That looks better for the bank. They have more transaction flow volume that they say, hey, we're a leader in this space, right, PR-wise. It keeps their customer happy because they have zero slippage. And internally, the bank itself makes that fee, because you're still charging the same fee, right? Except it's not going to the sales trader anymore. It's just going to the bank's P&L. So this is kind of the history of a dark pool. We can go into the fuck-ups of the dark pools with Barclays and Goldman. Barclays they just didn't write down what they were doing. It just didn't match their algo. So that was just kind of like false advertising. Goldman, the price fee that the dark pool was using was actually slower than what the lit market was. So high frequency firms would come in knowing what the actual market was, and they were able to arb what the dark pool knew as the best bid and best offer at that point in time. So Goldman got fined on that. But I think they fixed it, and now they have like, I think they have the NASDAQ as like the third party ensuring that the dark pool is doing what the docs say that they're supposed to do. So that is now the status of dark pools in the real world. Okay, your turn.
Amazing. Okay, so how do they work sort of on a micro level? So if I want to, first of all, who's showing up to this dark pool? So what are the usual suspects trading on the dark pool?
It's pretty much the same, I think, as the lit pool. You have your market makers to some extent, and then you have, I think, larger institutions. So we'll keep retail out of it because retail usually doesn't have access to dark pools. It's more of an institutional side, and so those are the major players.
And so how would I decide across trading venues what to do? I can also do OTC still, right? So banks still do OTC?
They do OTC, but probably not on the products that are in a dark pool.
Which would be usually?
Usually liquid securities that are on a lit exchange. So like a OTC desk would be like something random like convertible bonds or options or bonds, things that don't really have a very liquid lit market. Does everybody know lit?
Does everybody speak finance?
Finance, yeah. Everybody here speaks crypto. Does everybody speak finance? It's okay if you don't.
What is a lit pool?
A lit pool is like when you can actually see the central limit order book. Right?
Just the opposite of a dark pool.
It's the opposite of a dark pool. Yeah.
Okay.
Good question.
Nice. And so if I put my equity order in so how is the process? So is there some kind of order matching happening in the?
Yes, there's an order matching. So technically, the dark pool still has like a limit order book, right? How the orders get matched kind of depends. Like exchanges are pretty straightforward, right? They usually have FIFO, and then it's like an allocation. Dark pools can be a little bit more dependent, but they have to state how it's matched, right? So you can go to the different exchanges, dark pool exchanges, and read how they match it. Some will match it based on the mid price of the best bid and the best offer. Some will use like weighted prices. Yeah.
Okay. And so if you make a market or if you're a market making firm or something like that, in a dark pool, how would you operate? How would you operate differently from a lit pool?
So you know what the lit price is, right? So you're kind of leaning on that for your dark pool.
Mm-hmm.
But since you typically know that there's more liquidity, instead of being super tight, you probably would be a little bit wider for more size, right? So that still gives you an opportunity. If you get filled in a dark pool, you can hedge it out and make some money on the lit exchange. Is typically how it would work.
And that also means that you have basically less frequent sort of prices emerging. So
Less trade frequency.
Okay.
Yeah.
And so the prices, do we figure them out actually? So if some trade was cleared in the dark pool, how do we learn about it?
They usually have to print it to the pool. So you would see the price print. There's also like OTC, how the OTC does. Like for options, you would still see like, okay, this is crossing at this price, or this trade happened, and it would have the timestamp. It has to be within like a certain time frame, like 30 or 45 minutes. Maybe it's less now. I don't know. Back in my day, it was 30 minutes, but it could be faster now.
Okay. So it was quite some delay, essentially.
Yeah, but you have to understand, like the delay can come from, in certain markets, back in my day, there were still paper tickets, like due for buy, paying for sell. So you had to like fill out your paper ticket, you had to stamp it, you had to there's a lot of things that could take forever. So that's why you had like 30 minutes. And then even like, even now, I think if it's electronically settled, I think you send it to some system and then they prepare it. So it's not necessarily up to you when it's printed.
Can I ask you a complicated question?
Do we have Claude? My friend Claude can help you.
No, is this sort of this dark central limit order book, is this good design? Do you think that is the way you should operate such a exchange? How would we think about designing those places? Is there anything that can totally go wrong?
So think of it as use case, right? It's product market fit for their customers, which are hedge funds and institutions. So from a user perspective, they're going to use it if it's more beneficial to them, right? If they're not going to use it, then they would go back to the old method of calling a broker and having it split out. However, some brokers still do call around markets. Some brokers, they have an algorithm that they'll just do like a TWAP over it. Then they split it amongst many brokers as well, right? If you're a big enough size in an institution. So there's many options for a hedge fund to execute their trade with the least slippage possible. Like an execution trader at a hedge fund, your one goal is just to minimize slippage. Like, that's it. It's not about making money for your firm. You're not scalping anything. You're just like, how can I minimize slippage, and how can I make sure that, you know, we're trying to get in at this price, we're trying to get out at that price. How can I get as close to that as possible? And if you do that, your job is done, right? There's no thinking involved so much as in, this is a little task. So they'll use whatever that they need to use to make sure that task is done.
Okay, so you're saying market design doesn't matter at all, and we should cancel this workshop here.
Yeah. Thank you. Yeah. My job is done.
Okay, questions from the audience?
Yeah.
Yeah, I remember like some exchange they have this kind of order called iceberg order.
Yeah, okay.
Is that a form of dark pool?
Not really. So iceberg order is, so sometimes your book is pretty thin, right? Like say Hong Kong, Hang Seng, right? If you look at Hang Seng, they have small tick sizes. So on every tick, it might just be a 1 lot, a 2 lot. If you show a 10 lot, it's like a lot. People start moving away from you, right? So what an iceberg order basically does is, if I have like, I want to get done 30 or something, and I'm like, shit, well, I can only show like 2 or 3 at a time. Be like, okay, I'm gonna hide my full order of 30, and I'm only gonna show 2. So it'll keep showing 2. And with the volatility of a thin market, things bounce around a lot. You don't really see it until all of a sudden you start to feel a lot of pressure on that selling, and you're like, wait a second. All these other orders behind it are like, there's nothing there, but there's always getting filled at a 2. And that's when you know you found an iceberg. So the iceberg only continually shows that initial part that you want, the tip part, right, that you want to show until you complete the entire order. Yeah. It's usually for very thin markets. If you're like on NASDAQ with big ticks, you can have a lot of liquidity on those ticks. You don't really need it. It's for like very small tick. Like if you're like whiff or something, like point, I don't even know how many zeros are before. Maybe whiff's not a good one. But like, you know, Pepe or something, there's like 4 zeros or something before that, right? That's such a small little tick increment, right? So you would try to aggregate if you really wanted liquidity to maybe, sometimes you aggregate liquidity on bigger ticks, so like every 5 or every 10. And then sometimes you just use icebergs.
I remember this.
Can you tell us on the mic?
Oh, sorry.
Yeah. Boom. Just hand it back.
I remember there is a case, US-based Korean hedge fund manager, because running out of margin or something called margin call, and those Goldman Sachs or some IIS sell the position. Are they doing this through dark pool or something?
No, usually they just, it depends. Okay, the answer is it depends on the size of the position.
Very huge size.
Yeah, so in the case of very huge size, what they would actually do is they would call around. Right, if it's smaller size, it would go straight to the market, right? Because they just want liquidity. But if they know you're gonna actually disrupt the market, and so that's big of a size, because if you did that, you would cause everybody else to mark their books down, and you cause cascading effects, right? So if you're Goldman and you have a margin call and you're like, well, fuck, this is really big, you would call up other, usually there's a clearinghouse, and the clearinghouse would take care of it. In case that didn't happen, you would try to call out other, say, prop shops or market makers and try to get that done in private at enough of a price without disrupting market as possible. Like the prop shop is gonna like take as much as they can get, right? Because there is risk there, and they're not gonna do it unless there's a discount. Think of it as when like FTX, right? So right now the FTX bankruptcy, the auctioneer is selling like SOL. They're selling stakes or vesting SOL, right? People are paying like, they're bidding like 60 cents on the dollar, 70 cents on the dollar. It's the same thing, right? It's a distressed book that you're just trying to get rid of and try to get as much cash back as possible. Yeah.
How do order cancellations work in a TradFi dark pool? Like, can I, where's the, okay. Can I call up like, I don't know, Goldman and say I want to sell like a huge position, and then call them 5 minutes later and say, haha, just kidding? Or like, yeah, and then you do that to try to like, I don't know, get them to call around and push the market a certain direction, or try to figure out who else is trying to use the dark pool, or will they just say like, nope, you already said that you wanted to do it, no dice, sorry, we're already, like, you better have the equities.
So usually, if they execute, whatever they execute for you up until when you cancel it, you're good. You have to make good on that, right?
Yeah.
That's bound because you're on a phone. That phone is recorded. It's a recorded order. You can't just keep calling and spoofing because that's a market violation.
Okay.
Right? There's market manipulation in this case, right? So there's regulations. So you can't just say, oh, I want to sell 5 million things, and you don't actually have that 5 million. You can't do that, especially if it's not on borrow or anything.
Okay.
Right? Yeah.
Cool.
That doesn't exist because regulations.
You can probably do that with the current household plans, no?
Cost swap?
Yeah, or like if you're on like Jupiter, the Jupiter DCA book, like because the Jupiter themselves they have their own server of like all the DCA that's going on.
Yeah, crypto, no regulation.
They will look at it. Oh my
Wait,
god, this
Mika,
massive cell phone.
just no front running, right? We'll defer to you. Yeah. This is not legal advice. We don't give any legal advice or trading advice. Yeah.
Perfect regulation in crypto.
But I think one.
Write our regulation to code, you know.
Yeah, because one day I was thinking like
Code is
when I was using Jupiter and there was. Whoa.
Say your name and say exactly what strategy you're talking about.
No, because I was thinking about the Jupyter's DCA, which is all running on their centralized book on their AWS, and I was like, oh my god, like Jupyter has so much market advantage because they see everyone trying to DCA into and out of certain position, and they're in such a good position as well. I was like, gosh, like, imagine you being a Jupyter operator. Like, you have so much growth. Just internally.
It depends where they're registered as their entity, right?
Well, probably not a USA.
Yeah.
Okay, any more questions? I have one.
I have another one.
You have a question?
You want to try it?
Let's do it. It's sweating.
I guess that's more of like already maybe a bit of a research question, but do you have any opinions or thoughts about what is the impact of publishing the trade versus maybe not publishing it to the book later, once it's settled basically?
In TradFi?
Yeah.
Oh, you have to publish it.
Okay.
Yeah, you have to publish it.
Okay.
Yeah.
But then basically all of a sudden a big trade already settled shows up.
That's usually, so if you see a trade and it happened off chain, you're like, oh fuck, but it's already too late, right? So it doesn't disrupt the market.
Yeah,
So you can make some sort of assumption, but you don't know if somebody was buying or somebody's selling, right? So you don't actually know where there's no information leakage in that side, unless you know exactly who is doing that, but you wouldn't know in that situation.
Can I have a
Sorry.
One-handed.
Yeah. Do you have a follow-up to that one, or?
Yeah,
go
you
ahead.
said unless you know who the party is.
But
Why would that?
Because you would, if you know who the party is, like most hedge funds, they have to, I think, report, at least in the US, a 13F, right, quarterly summation of their positions, right? So if you know who that party was, you already know what their previous position was, right? You can have an idea, okay, adding or subtracting, whatever.
Okay, I got a two-part question. First up is, well, anyway. First one is, could you maybe go over like 3 different types of architectural designs of dark pools? Like, how do they actually work? Like, is it?
So this is their topic for building things. So
Yeah. But just like give the basic idea. And second, what is the impact of dark pools on like the public market? If more liquidity goes into a dark pool for large trades, how does it impact liquidity of the public market?
So I'll do the second one first, because that seems easier. And then maybe my friend Claude can come over. Well, just in the last example, ideally with that dark pool, you wouldn't have an impact on the lit market, right? You're trying to minimize it. So you just know that somebody traded, something happened, but you don't know whether or not the knowledge was in one direction or another. So ideally, it's just some sort of crossing. Maybe somebody had some sort of thing. I mean, you can kind of guess because okay, somebody was the initial seller because the price was a little bit lower or stuff like that. But if the dark pool is done right and it's crossed at the mid price, you would have no idea, right? So then it's just like, oh, people were interested. There was a trade. Okay.
What percent of the market or a given market is dark?
15%.
Clyde.
15. That's of like what market?
Total trading volume.
Oh,
What do we know that?
ChatGPT.
Yes.
That was kind of my question. So I have like a non-ChatGPT follow-up to that.
Damn it, no.
What are like the market forces that govern the equilibrium of like how much liquidity lives on the dark pool versus the lit pool?
That's a good question.
Sweet, I'm done.
Yeah. I think there's pretty much, if all things being equal, if there was just like market makers and banks, they would be somewhat of a similar balance. Like there wouldn't be an imbalance in the dark pool. I think it gets interesting when there's a lot of volatility in the market. And that's probably where you see different types of funds trying to reposition their book, right? You have value guys that might come in and buy, and then you have like other guys who might have a certain thesis. They might be taking money off the table, selling. So I think you would have imbalances, and it would really be market dependent.
Why don't we have 100% in the dark pool?
100%.
To take the extreme diversion. Why is not everything in the dark pool?
That's an easy.
Okay.
Yeah.
Not the easy answer, not the price discovery answer.
But honestly, no. But how do you make a market when there's no, sort of information aggregation, right? So it's very hard to run an efficient market if there's no signals that we can publicly coordinate.
Do you need public coordination for signal? And can't you just put limit orders into a dark pool based on your information?
Yeah. Also, I mean, a dark pool is also leaking information in some sense, right? So it's just a more complicated endeavor, I suppose, to figure out what is sort of the depth of the order book in a dark book, right?
Yeah, so I can give you an example of the trading strategy because this is what we used to run in TRW, or the algo team ran this in TRW. So at one point in time, you can ping for liquidity, right? Because if you're a big firm and you're saying, okay, I want to only buy at this price, you put your bid in the order book, right? And so if you're searching for liquidity, you would just throw out one lots or very small liquid sizes, and you're just trying to see, okay, it's going to be, I'm trying to sell, and then you hit this like liquidity. You're like, oh, I found a liquidity. It's like searching for icebergs, right? You hit it, all right, hit it again, right? The markets go a little bit lower, but you still found it. You're like, oh, there's this, somewhere in this dark pool is a bid that is a little bit higher than what I know the lit market to be. Here's where this actual liquidity is. I have a large buyer here. Am I gonna sell to him? Probably not. I'm gonna buy up in the lit market knowing that I found a big buyer there. And so this is what like algo traders kind of do. And this is more prevalent, again, when you have like a little bit of a maybe different pricing stream latency between lit and dark. That's probably why it's a little bit more prevalent. But you know, that inefficiency exists, or did back in my day.
Section on orders.
So as a sort of in-between solution, could we also have a shady pool where we sort of have hints to, I don't know, give a hint to the market, so I want to do roughly this, I don't know. Would that improve sort of UX from the trader perspective, or is this completely useless?
I think if I knew a hint and, okay, so like as a trader, it'd be, besides knowing what you wanted to trade, right? So know what you want to trade. If there's anything around size and direction, that's all I need to try to like move my book around you, right? That's kind of the essence of like sort of front running, right? Is kind of, I don't even need to know your price. Like your price could be further away, but I was like, I know the demand is in this direction, and I'm gonna do something about that.
That makes sense.
I have two questions. One is like,
is dark pool similar to is dark pool a competitor of NASDAQ in traditional finance? Because they are taking the trading volumes from NASDAQ.
I don't think so per se, because like a lot of times you'll see like those lit exchanges, especially like NASDAQ, they're partnered already with the dark pool, so it's like if they're part of it, they're just subsidiary. That's the lit pool is NASDAQ, and they're doing maybe the clearing, or it's the members that are in the dark pool, and it just crossed and it goes directly back to NASDAQ. So,
Yeah, another question is because we're talking about spot trading right now, I was just curious, in traditional finance, it's maybe it's too hard to record options in dark pool, but maybe in DeFi to record actual tradings in dark pool. That is actually a pretty interesting.
Futures are not that similar, different from spot, right?
Yeah, Delta One. I feel like any Delta One, but the question then is going to be liquidity, right? So as long as you have the liquidity, you can put anything. I think you're right. Options are a little bit difficult because you have to know also their delta and all this other things. But like any Delta One product, Delta One means that it moves 1 for 1.
Mm-hmm.
Again, finance today. Okay.
And maybe last question, I think.
Because after all, my understanding is dark pool is to allow those big institutions to sell sizable stocks without having some big price impact in the public market. So would like to know, because there are different ways to do it, so what do you think would be the pros and cons of the mechanisms that try to achieve the same goal?
Like which one in particular?
For example, calling different counterparties to settle those larger trades versus using dark pool to settle the trades.
What's a trader's perspective? You said it doesn't matter. This is what I got from you, right? So it fundamentally doesn't matter how you trade. You just trade.
Yeah.
You just trade where the liquidity is.
Yeah, you're basically minimizing slippage is kind of like what the institution wants to do. Institution, by the way, could also mean like family offices, or it could be like smaller funds, smaller liquid funds. It could be illiquid funds. It could be pension funds as well, right? It's all, there's a spectrum of what I mean by institutions. So maybe on crypto side, it could be like whales or like VC funds because they're trying to exit liquidity because they have to return money to the investors, or hedge funds, liquid token funds, ETFs. You have a spectrum of institutions on crypto side too. So.
All right, timing game, one last question.
All right. I just wanted to follow up on Christoph's answer. So, I get that you can't have all the liquidity in the dark pool because then you don't have price discovery, but that's a market problem. What prevents the tragedy of the commons of everyone trying to do that anyway? At the end of the day, just because price discovery is a better emergent property, what incentivizes people to contribute to price discovery?
I mean, it's sort of, I always thought it's usually a coordination thing, right? That's usually not the best market design wins in finance. Correct me if I'm wrong, it's very much path dependent, right? We know also in our blockchain world that sort of it's very sticky what is already developed, right? So that doesn't really answer your question, I suppose. It's a big coordination problem. The best design doesn't win. Why do we do this workshop here? Why do we do this workshop if design isn't first order?
That's not true. We have batch auctions where there were no batch auctions in TradFi.
Yeah.
Now we have.
No, there's batch auctions in TradFi. Any sort of opening and closing is a batch auction on any exchange.
Yeah.
Don't be so defeatist. Market design does matter a lot.
Okay.
But you're operating without the constraints that TradFi is, so you should have more design.
Oh,
place.
what were the constraints?
Regulations.
So let's build something dark. Okay.